Hey, it's Ryan, back with episode 2 of Beginner Meets Pro Business Insights, the real game of stocks. If you want to find out more about me, feel free to check out my first episode. Today, we're diving into a big topic, stocks. What they are, how people make money with them, and how they work. Now let's be honest, when you hear the word stocks, you probably think of people at Wall Street in suits arguing about numbers. But honestly, it isn't all about that. In fact, after this episode, you will know everything that you need to about stocks. Let's start from the very basics. What is a stock? How can you use stocks to get rich? A stock is basically a piece of a company, not a physical piece, but more of a piece of its ownership. When you buy a stock, you're buying a small part of ownership in that company. You can think of it as a giant pizza, and a stock is a slice from that pizza. Companies sell these slices, which is just stocks, to make money to do whatever they want. There could be staff or more products or more stores. If a company does good, then the value of the stock goes up. And if the company starts doing worse, then the value of the stock starts going down. Some companies will even pay you money called a dividend for holding their stocks, like a little thank you note. Not all companies do this, but the big ones do. For example, if I buy a stock for $5 and every month I hold that stock, I keep it without selling it, I get $3 back. Then that means in 2 months I would have got $6 in dividends and I still have $5 worth of that stock. Hopefully it hasn't changed in price. Speaking of price changes, when a stock goes up in value and you sell it, it's called capital gains. Let's say that my $5 stock in 2 months goes up by $2 and now it's worth $7. Once I sell it, my capital gains would have been $2. Now you don't actually get this profit until you sold it. It could change. Until you sell it, it's called potential profit, or for a fancier term, unrealized gain. The way a stock price moves, or how quickly a stock price changes, is called market volatility. If a stock swings up and down, jumping left and right day to day, then it is considered volatile. It doesn't always mean that the stock is bad, but it is more risky and sensitive. Volatility can be affected by news, investors, company earnings, and sometimes even global events. The more volatile, the harder it is to predict a stock. Now, how can you use all this to figure out what kind of stock you should buy? There are 2 main types of stocks, growth stocks and value stocks. And they are very different when it comes to how you should invest in them and what to know about them. Growth stocks are stocks of companies that are just starting off. For example, if I just started a new business and I had stocks for them, that would be a growth stock, like when Amazon was just starting off. These companies usually don't pay dividends, since they're using most of their money to reinvest into their company. The goal here is to buy stock when it's low, wait for it to grow, and sell it when it's worth a good amount. This is risky, however, because my company, or I guess let's say beginner Amazon, could crash or who knows what, but it has a good reward potential. Value stocks are almost like the complete opposite. They are companies that have already been established and know what they've been doing. For example, Coca-Cola, or maybe even RBC. But the key with value stocks is that they're selling for less than they're worth, like it's on discount. These companies will usually pay a dividend, grow slowly but steadily. The goal here is to buy a stock when it's on sale and wait for it to grow while being paid dividends. This is a lot less risky since the company is already established and there's way lower chances of losing high levels of value. Now, depending on the stock, you can use different types of trading. When it comes to the stock market, there are 2 types of trading: short-term or day trading and long-term trading. Short-term is buying and selling stocks quickly within hours and sometimes minutes and trying to make money off of the price swings. It is basically like trying to predict every wave in the ocean. So it's very, very tricky. If you get it right, you can make a lot of money, but it can be stressful, risky, and you can lose money just as fast. Plus, it takes a lot of time, skill, and focus. Long-term trading is buying stocks and holding them for up to years, waiting it out the ups and downs, like planting a tree and letting it grow. You'll get money from long-term growth, sometimes even dividends, plus it's a lot less stressful. On the other hand, you do still have to worry about losing money, but you won't have to hyperfixate over every small price change. As a young investor, you should look into long-term investing. This is because you most likely have a good amount of time on your hands, hopefully not too many bills to pay, and you can focus on learning, building habits, and watching your investments grow. Day trading can seem cool, but many beginners tend to lose money since they don't even know what they're doing or what they need to know. For now, I recommend long-term trading, studying slow, and thinking big. Millionaires aren't born overnight. What millionaires do is make mistakes as beginners. So, here are a couple mistakes that you should watch out for. Common beginner mistakes are emotional investing, chasing hype, and ignoring research. Emotional investing is buying or selling stocks without fully thinking about it or thinking about the logic. It's more of just using your emotions to make your decisions. For example, you could panic when a stock price drops down and immediately sell so you don't lose any more money. Or you can get overconfident when the stock price goes up and you're like, oh, I got this. Investing isn't about the vibes or how you're feeling. It's about staying calm always, even if you may be losing some money. Chasing hype is when you follow trends and buy or sell stocks because everyone else is doing so. One example that this happened in real life was GameStop. Everyone thought that it would be amazing and it blew up super fast, but then it crashed down just as fast. If you're buying stocks just because some guy on TikTok told you to, then it is no different from gambling. Ignoring research is another mistake that beginners tend to make. It is a very important part of investing because if you don't know what a company does, how it makes money, or who its competition may be, then you know nothing about the company. For example, if I'm investing in Apple and Samsung releases this brand new top-of-the-line phone that everyone loves and is going to buy, then I should expect a drop in value from Apple as a stock. I would only know this though if I put in some research or knew how Apple makes their money. Those are the 3 mistakes that beginners tend to make very often. And now that you know about them, hopefully you'll be able to watch out and have a keen eye whenever you do seem like you're making some of these mistakes. Some tips will be always try to get a second opinion when you're changing and buying stocks. Now you should know all about stocks, what they are, and how to choose which ones to buy. In the next episodes, I'm going to be in the Cayman Islands, an investment haven. I'm going to be going with some local college students, and I'll have amazing chances to interview people who invest in their day-to-day lives. That's going to be a lot of fun. Thanks for listening to Beginner Meets Pro Business Insights. I'm Ryan, and this is just the beginning of our journey. If you like this episode, feel free to share it with someone else who's trying to figure out the do's and don'ts of investing. Catch you next time from the Cayman Islands.